Hi, I'm Kylie Mathieu and welcome to Wealthy Millionaire. Today we're going to talk about how to get pre-approved for your mortgage. Disclaimer, I'm not a lawyer, I'm not a real estate agent, I'm not an accountant, so please always make sure to reach out to a professional first. So how do you get pre-approved for a mortgage? If you're in the market for a new home and you require a mortgage, it's essential that you get a pre-approval first. A mortgage pre-approval document proves that a lender has already agreed to loan you a certain amount of money for you to buy your home. Pre-approval can help streamline the home buying process and make your offers more competitive. Getting pre-approved also allows you to know your budget and house hunt accordingly. However, to make sure your pre-approved mortgage goes through, you want to make sure that your home meets specific criteria and that your financial situation doesn't change drastically during the home shopping period. So why should you get pre-approved? A mortgage pre-approval isn't necessarily mandatory. However, getting pre-approved makes the home buying process more efficient and provides an opportunity for you to compare loan options and solidify your budget. It is important to be clear on your budget and the monthly repayments you can comfortably afford. This saves you time as you can eliminate homes that are out of your budget. It also prevents you from committing to a home that will stress your finances for years to come. Pre-approval also shows sellers and real estate agents that you're a serious buyer and can afford a home. Sellers want to know that a buyer can follow through with the financing, and being pre-approved gives you a much higher chance of having your offers accepted and securing your dream home. Some people wonder if a mortgage pre-approval will hurt your credit score. Well, during the pre-approval process, a lender assesses your credit worthiness. Then they determine the amount of money that you can borrow and estimate your monthly payment. This will show on your credit score. And like any credit check, that can lower your credit score. However, if you're seeking a pre-approval from multiple lenders in a short amount of time, they will only count as one hit on your credit report. Getting a pre-approval follows a review of a buyer's financial profile. A favorable financial profile quickens loan and mortgage pre-approval and will qualify you for better rates. Lenders base a pre-approval on the following key factors: assets and liabilities, credit score, credit history, debt to income ratio, and employment history. There's two terms that people like to use: pre-approval and pre-qualification. Most people use these terms interchangeably, however, they refer to different processes. Pre-qualification is an estimation of your loan amount, and it only involves a soft credit inquiry, so no documentation is necessary for that process. Therefore, the lender only relies on your presentation of your financial situation. Unlike a pre-approval, getting qualified doesn't involve any commitment on the part of the lender. The mortgage rate they offer you could go up when you return to take out a mortgage. And pre-qualification documents can't stand in for pre-approval when making your offer on a home. So a few things a lender will require as an overview for the pre-qualification is your finances, income, debts. Pre-qualification is helpful when shopping and comparing loan terms. However, it carries no weight as sellers and real estate agents don't take it seriously. A pre-approval is more of a detailed process. You'll need to fill out a mortgage application and provide your social security number. The lender will use this number for a hard credit check. They're also going to want to see your bank account information, assets, debts, income, employment history, as well as past addresses. With a pre-approval, the lender has checked and verified your documents in order to offer you an accurate loan amount. The specific loan amount that the lender offers you will hold for several months. So you shouldn't be surprised by the high rates or a lower loan amount when it comes time to take out your mortgage. So when would be a good time to get a pre-approval? Pre-approval letters are actually valid for 60 to 90 days. They have an expiration date because a buyer's finances and credit profile can change over a long period of time. If your pre-approval expires, you'll need to fill out a mortgage application with updated paperwork. You may not be able to get the same loan that you were offered previously. It is advisable that you seek pre-approval 6 months to 1 year before a serious home search. This gives you time to address any credit issues identified and improve your financial standing as necessary. You'll also have more time to save for a down payment and closing costs. How long it takes to get pre-approved depends on your lender and financial complexities. If you're lucky, you can get pre-approved within days or even hours of applying. The application process involves filling out a mortgage application, and this application can be quite demanding. A mortgage application has 8 main sections. So let's take a look at them. First, the type of mortgage and terms of the loan. So this section details the particular loan product you're seeking, and it includes the loan amount and the terms such as loan repayment duration and interest rate. Second is your property information and the purpose of the loan. So this section provides information on the relevant home and how the loan will be used. So this includes information like your address, legal description of the property, year of development, loan purpose, intended types of residency. Third is your personal information. So this section regards to your identifying information, such as your name, your birth date, social security number, years of schooling, marital status, number of dependents, and address history. Next is your employment information. So this section includes the name and contact information of your current and past employers, dates of employment, title, and monthly income. Next is your combined income and monthly housing. So this includes things like your base monthly income, any overtime, bonuses, commissions, rental incomes, dividends or interest, any other monthly incomes, and monthly combined housing expenses. So number 6 is assets and liabilities. So they're going to take a look at things like your bank and credit card statements, life insurance, stocks, bonds, retirement savings, mutual funds accounts, liabilities, and debts. Next, they're going to look at the details of the transaction. So the purchase price, loan amounts, the value of improvements and repairs that need to be done, the estimated closing cost, buyer paid discounts, and mortgage insurance, if applicable. Number 8, they're going to look at any declarations. So any judgments, liens, past bankruptcies or foreclosures, pending lawsuits, or delinquent debts. Whether a U.S. citizen or you're a permanent resident, as well whether you intend to use your home as a primary residence or not. So your next steps would be that your lender will provide you with a loan estimate, and the law requires the lender to do so within 3 working days of receiving your application. The loan estimate is a 3-page document that states you have a pre-approval and outlines the following. There will be a loan amount, terms and type of mortgage, interest rate, estimated interest and payments, estimated closing costs including any lender's fees, an estimate of property tax and homeowner's insurance. So once your application closes, your loan file goes to a loan underwriter. The underwriter will review all documents against the information on your mortgage application. They will ensure that you satisfy the requirements of each mortgage program. So there are many documents required for pre-approval. You also need to put together documents to verify the information that you provided. So these include things like bank statements for the last 60 days, pay stubs, previous 2 years W-2 tax returns, scheduled K-1 for self-employed borrowers, income tax returns, asset account statements, and a driver's license or U.S. passport. There are some factors that impact your pre-approval. It's essential that you understand what lenders assess in your financial profile. So this information will help you maximize your chances for pre-approval. These factors include debt-to-income ratio, which is called DTI. Your DTI is the amount of monthly debt you have outstanding as a percentage of your monthly income. You typically need a DTI of 43% or lower to qualify for your mortgage. And the lower your DTI, the lower the interest rates that you can qualify for. Then there's the loan-to-value ratio, the LTV. The LTV is the loan amount divided by the home value. So the best way to lower the LTV is to make a larger down payment on the home, as this lowers the loan amount. If you're struggling to make a substantial down payment, you may want to look into an FHA loan. These loans only require a 3.5% down payment, meaning the FHA, maximum loan to value ratio, is 96.5%. Lenders will also take a look at your credit score. So they'll review your credit history to see what kind of credit lines you have open and if you're consistently paying your bills on time. They'll also evaluate your credit score. So you generally need a score of 620 or above to be approved for a mortgage. Your employment history and income. So lenders will look at the past 2 years, W-2 tax forms, to ensure you have a stable enough income to commit to a mortgage. You'll also have to show bank statements to prove that you have saved enough for your income to afford a down payment and closing costs. If your financial standing is not strong enough to qualify for a mortgage that is sufficient and affordable for you, consider taking some time to pay off some debts and save some money. This will put you in a better position to qualify for a loan and get a lower interest rate. After the lender takes a look at your application, they could make one of the 3 decisions. Pre-approved, congratulations. If you're happy with the terms of the mortgage that they offered, you can start shopping for houses within your budget. 2, you get denied. In this case, the lender needs to explain to you the reason for this decision, and it's also necessary that the lender provide sources to resolve the issues that led to the denial. You'll likely have to take some time to improve your credit score or savings before trying to apply again. Or 3, pre-approved with conditions. In this scenario, the lender may require that you provide additional documents. You may also need to lower your DTI ratio by paying down some credit accounts. This condition could also include withdrawing from your 401k for the down payment. Purchasing a home can be an intimidating and scary process. I hope this episode helped. I'm Kylie Mathieu, and thank you for watching Wealthy Millionaire.